Welcome, it's Mary Ellen McGonigal, Senior Managing Director of Equities here at Simpler Trading with your weekly Edge Show. Today, as usual, we will go ahead and take a look at where the markets closed. Quite a volatile period last week, ending on a somewhat high note and beyond. We will take a look beneath the surface. There are pockets of strength that are continuing to bubble up despite an overall negative market environment. From there, we'll take a look at some of the more impactful headline news that drove price action last week, and then viewer question of the week. And this week, the question is all about, should you buy this pullback? And my answer is selectively yes, and I will show you which areas, which couple of stocks, and how you can do just that, what to be on the lookout for. So from here, again, let's take a look at that news that drove the markets last week. First up, the most impactful was the fact that the Federal Reserve did vote to raise rates by 0.75%. That was as expected, but certainly not entirely anticipated was Fed Chair Powell's repeated comment that we are in nowhere close to an environment where the Fed can consider easing on their aggressive rate hike policy cycle. So from there, we did see Chicago PMI data showing a contraction in manufacturing. In fact, that was earlier in the week. And we are in that phase where negative economic data is actually positive for the markets. The Federal Reserve is on the lookout to slow the economy, and this was one indication that it may be taking shape. However, as the week moved on, factory orders did rise, and most importantly, on Friday, we did see the U.S. adding more jobs than anticipated in October. Not good news there. It did push the markets quite a bit lower into the open, but then we will take a look at what occurred later on that Friday. Next week, very important on the data front, we will get core CPI or consumer price index numbers on Thursday. This is a very closely watched gauge of inflation. The Federal Reserve will be keying in on this, as certainly will be investors. Also up next week is consumer sentiment data, and then throughout the week, there will be Federal Reserve officials that will be at speaking engagements. We know from the past that this can be a market driver depending on their comments. So let's go ahead and take a look. Where did we close for the week? Here we are with a daily price chart of the S&P 500. A couple of things to point out here is that significant drop on Wednesday following the Fed's announcement did get followed by further deterioration on Thursday, which pushed the S&P 500 below this pink 21-day simple moving average. The good news is on Friday, we did experience a late day rally that pushed this index back above this moving average. The relevance here is that this 21-day simple moving average was the last near-term possible area of support for the markets, and had we closed below that, we would be on the lookout for this mid-October low as the next area of possible support. So at this time, we are still above that 21-day. However, let's take a look at these momentum indicators. The RSI, that's a relative strength indicator. It did close the week in negative territory, heading upward. We're close to turning positive, but not quite there. Faster moving stochastic, that's another momentum indicator. It did close below that 50 and is heading lower. So net, we do have negative momentum. And the broader market indice remains below this key 50-day simple moving average, so near-term cautious on the markets. From here, let's take a look at some of those 11 sectors within the S&P 500. This is a 2-month daily price chart view of those sectors. I've added a relative strength indicator and sorted this group in descending order. We want to see where the relative strength is in the markets, primarily so that you'll know where you are better served to be on the lookout for possible candidates, primarily if that industry group is in a positive position. We'll get into that as we move through here. Also, you want to be equally aware of the weaker areas and make sure you're not highly represented or weighted in those weaker areas that are poised to head lower. So up here at the forefront, and as it has been for quite some time, energy stocks, XLE, we can see in a very nice confirmed uptrend, outside momentum indicators heading upward. This is all about earnings. These companies are coming out with triple-digit growth in this most recent third quarter. But even more importantly, most times management is guiding their growth estimates higher, so lots of vibrancy there in the energy space. One other factor with energy is that the industry group can fare well and often will fare well despite a rising interest rate environment. We need only look at the beginning of the year when we got into energy back here in January and how the group ascended despite rising interest rates. From here, we can take a look at other groups that are on the move. This is industrial. XLI is back above that 10-day simple moving average with outside bullish momentum indicators, all about earnings. Lots of these companies that are in the industrial sector are reporting really above estimates, and it's very interesting to see that. Next up, our financials, not quite in positive territory, but it was a relative outperformer this week, keeping our eye on this group because there are select areas, investment management firms, and so on, insurance, another one, that are faring well within financials, but the group not quite ready for prime time. Up here as well are basic materials. We did see gold have a nice bounce today as we move forward. I'll share one of the reasons for that, but it's not quite in positive territory, but it's another area where many companies, steel related and otherwise, are reporting very good earnings for that third quarter. Healthcare is up here at the forefront as well. And for those of you that subscribe to my MEM Edge report, you will know that we have been following this very closely. In this next segment, I'll share with you one subcategory within healthcare that's really perked up quite a bit and looks good. From here, also, you do, as mentioned, want to be aware of those weaker areas. And down here in this lower quartile, primarily are those growth areas of the market. Let's take a look. Technology down. Let's take a look at where, probably about 6%, 6.7%. And this is all about that rising interest rate environment being negative for these tech names. Another area that is not faring well is consumer discretionary. And we can see that this group also is in a declining phase. This is another area that is filled with growth stocks. And then last up, let's take a look at XLC, communication services. This area has been deteriorating for quite some time, certainly ahead of the top that we saw take place in the broader markets. Most impactful among these three groups also is the continued decline in mega cap names. We're talking about Tesla, Alphabet, Netflix, Meta, Amazon, Apple, all down double digits, and that's really pushing these groups down as well. From here, I do want to share with you some ETFs that I find super helpful as far as staying on top of growth versus value, what's working, what's not. Again, a 2-month daily price chart view. I'm going to go ahead and add an RSI, that relative strength indicator, and then sort this list in descending order. So up here in the forefront, we can see TNX, and this is the yield on the 10-year. I talked about rising interest rates being a negative, certainly for growth stocks, and we can see that the yield is back up above that 4% level, very psychologically critical as interest rates appear poised to trade higher. We could easily see further deterioration in those growth sectors. Also up here at the forefront, the Dow Jones Industrial Index, certainly the strongest among those major indices. It did come off of an October month period that was the strongest monthly performance. You'd have to go back to 1976 to see a stronger one, but very interesting in the fact that it's holding up well. The industrial index, we talked about industrial stocks, Caterpillar among them, but strength also in Starbucks, for instance, came out with good numbers, and energy is a component within the Dow as well, all holding up this index. And from here, we can take a look at other areas. For instance, semiconductors did have a sharp rally today, 4.5% on Friday, but we can see that overall that downtrend override remains in place. I'd be on the lookout for a breakup of that 50-day on heavy volume as a potential signal, but after spending time looking at the names within this industry group, there are only about 109 semiconductor stocks, and the names that are rallying the most are very small cap names. They are coming in with good numbers. I don't want to discount their moves, but overall, only a select few of the heavyweight names such as Nvidia are bouncing with the group. I would stay away until we see further broadening out and a healthy market industry group. Another area that impacted today a bit is this US dollar. We did see it dip almost 2%, and this would be one of the reasons that gold stocks and other metals rallied today. There also was merger activity that impacted the group as well. And then moving on to another area that is deteriorating and is actually good news, that is the volatility index. And it's rather confusing in the sense that the markets traded down this week. We saw how much the NASDAQ was down, but this sense that the volatility index is dropping could be a signal that fear is receding, and we will see what impact that has as it relates to the broader markets. Generally, a rising volatility index is not good for the broader markets. However, we are seeing a declining phase despite a drop in the markets. So we'll see what this may bring forth. But certainly volatility down at that 24.5 level is generally viewed as constructive for the broader markets. Last up, let's take a look at software stocks, simply because they really got beaten down this week. The sub-industry group was down double digits, and we can see this sharp drop as earnings have been helping support select groups such as healthcare and industrials. We are seeing earnings that are pushing select names in the software and the overall group down. And this software space is one area where corporations will pull back in their spending if there are any fears, or certainly if higher interest rates reduce their growth prospects. They will slow down in their software purchasing, and hence the drop that we're seeing. I do want to go ahead and talk about that pullback, because I mentioned to you in the sectors and some of the industry groups, there is underlying strength out there, and there is an ability for that strength to potentially continue because they've done well either in a recession or in a rising rate environment. So first name that I did want to share with you is TKR. Each of these names will have already reported their earnings, and we can see with this particular name, it is an industrial stock. And what I did want to point out to you is how the stock pulled back with the broader markets. Let's take a look at the dynamics that shaped up with that Wednesday into Thursday pullback. We can see that it undercut this 10-day simple moving average. However, it closed the day above it. Buyers came in on the dip, and it did so on big volume, which is very constructive. Today, it gapped up 3% in an effort to regain that prior high. So this is bullish price action when we undercut a near-term area of support. Buyers come in and it closes the day above that. That's what you will want to be on the lookout if you are anticipating purchasing stocks on a pullback. Let's take a look at another company that recently reported and experienced the very similar price action with that break below that 10-day. Buyers came in, it closed above, and then we had that gap up today as the stock continues to form the right side of the base. Another name that we can take a look at that reported a couple of weeks ago is Steel Dynamics, STLD, and they did come out with good numbers. More importantly, management guided growth higher, and we had a significant rally certainly for this stock, and we did see a pullback, an undercut of that 10-day. However, today we closed just at that 10-day simple moving average. You can use this grid over here as your guide, and that is constructive. I will want to see this MACD crossover take shape, but it does bode well for a potential forming of the right side of a base and a continuation rally. One other name that we can take a look at here that has pulled back after experienced a big move last week relating to earnings. This is Dexcom, a diabetic drug equipment company, and we can see this nice gap up that took place last week on very strong earnings last Friday and very big volume. When you have these big volume gap up experiences take shape, and we did have that happen back here October 10th when the company announced expansion of their products overseas. The stock did pull back, in this case to this 21-day simple moving average. I'll just take a minute to mark this up because it is worth noting that when you have these gaps up on big volume and they pull back, you want to see that volume generally dry up on that pullback, which it did in this case, and then it was able to recover from that. Let's take a look at this gap up here following last Friday's earnings. Huge volume, and for the most part, a drying up of volume on the pullback. In other words, it's not under distribution, it's simply profit taking on the light side. DXCM did find support at this 10-day simple moving average. I would view that as being in a nice buy point. We can also take a look at a company in the same space as it relates to diabetic equipment for those with diabetes. And this company just reported today. It's Insulet, PODD, huge volume on that gap up. The stock gapped up into a base breakout. And as you may note, I am highlighting stocks that are in healthcare and other areas that are showing relative outperformance. That's going to be one of the key components if you're considering buying on any pullback. Of course, this is a gap up. Use that DXCM as a guide to what may occur going forward, but overall, this is a very bullish chart. I will leave it at that. Everyone, I hope you have a wonderful weekend, and I look forward to seeing you here again next Friday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.